Although the exchange rate of Bitcoin and its volatility is still on the very high side, it's still one of the most popular cryptos in the cryptocurrency market. The volatility of Bitcoin is so bad that in March 2020, the price of Bitcoin was barely more than $4,000. But in April 2021, it nearly hit $65,000, only to go below half of that in 2022. The swing in the price of cryptocurrency is so bad that on some days they can go less than 10% of their opening day price. Although this volatility presents lots of trading opportunities for traders, it also makes regular transactions a problem. You would not want to buy them because you do not know what might happen to the price the next minute. Risky speculations, yes, that's very common with cryptocurrency. But what if you could, instead of Bitcoin or any other cryptocurrency, use a medium of exchange that is stable, also not a legal tender, and can be used to buy things for the short term? It would be amazing considering that the medium of exchange in question is stable. What if I told you those exist and they are known as stablecoins? They do. Stablecoins exist and are used as a medium of exchange that addresses the challenges of cryptocurrency volatility in a lot of ways. Think of what both fiat currency and crypto have that makes them very popular and trusted as a means of exchange. You guessed it right. But if you didn't, know that fiat currencies are stable. $1 will always remain $1, and they are very trusted. Crypto, on the other hand, offers privacy and security. Stablecoins combines these qualities and offers them to you on a platter of stable gold or coins, since they are stablecoins. Mind you, one stablecoin is pegged to $1 and will always be equal to $1, which helps to achieve one of the theoretical uses of Bitcoin, storing value. But since Bitcoin is not accepted by everyone and everywhere, it causes frequent changes in price, which defeat the purpose of storing value. You can ditch that idea of using Bitcoin to store your value, knowing well enough that stablecoins offer you a better deal. No price fluctuations, no speculative investment, and a greatly reduced investment risk. But stablecoins are not only pegged to US dollars, they are also pegged to other assets in the real world. Although they are also cryptocurrencies like Bitcoins and other cryptocurrencies, they are a bit developed to experience the level of volatility these other digital currencies experience. Stablecoins do not only represent a better investment option than other cryptocurrencies, they are also one of the important components of decentralized finance, also known as DeFi. If you don't know what those are, or how they work, you will find out sooner or later. But just so we can make progress, DeFi is not like your traditional financial system or services. They don't need a third party or a middleman. So you don't need a broker or a bank. Sweet! Fast and easy transactions! And stablecoins are gaining popularity as one of the largest and growing market caps on the crypto market. The likes of US dollar coin, and at some point Tether. But Tether is a whole different story for another video. Let's stick with stablecoins and how they work and why you should even need or use them. If you ever plan to use crypto for other kinds of financial transactions that differ from investing or trading, then you'll come in contact with stablecoins, especially if you will be financing, lending, or even borrowing. And even if stablecoins have all these interesting characteristics, they are not all created in the same way. Each stablecoin uses a unique way to have a stable value, and they also have their own specific and unique risks. So be careful which one you pick, and make sure you'll be tough enough to stomach any losses you might encounter. It's advisable not to invest more than you can bear to lose, or money you will be needing very soon. Let's go back to stablecoins and see how they work in the simplest way possible. To see that, you'll need to know the different types of stablecoins, which are not very different from each other except by the technology or policy they are backed by. Remember when I mentioned that stablecoins were pegged to real-world assets? Yes, That was me, lightly telling you that stablecoins are backed by a lot of sources. Fiat currency, or traditional currencies like the US dollar, is just one of them. They are also backed by precious metals like silver and gold, cryptocurrencies, and even some algorithmic functions. But those stablecoins backed by cryptocurrency are quite risky. Not risky in the sense of the word, but risky because cryptocurrencies themselves are very risky. Stablecoins backed by fiat currencies are different from those backed by crypto, but first, they are more stable. And you should know that. Since they are backed by fiat currency, they are linked to a central governing body. These bodies regulate their prices and help prevent frequent price fluctuations. In the other sense, they are controlled, regulated, safe, more stable, and the stablecoins you should look out for. Stablecoins based on fiat currencies are better described as IOUs, where you can use your dollars or any other traditional currency to buy stablecoins that you can later use to redeem your money back. Yes, they are cryptocurrency, but they are not as volatile as other cryptos. Even if they ever experience a price change, the fluctuations are never as rapid as with other cryptos, making them your safe bet for investing in the crypto world with reduced risk. Remember that they are still new, so you need to exercise caution when investing in them. Although I'll tell you before the end of this video where to buy stablecoins, you can buy fiat-based stablecoins like the US dollar coins on Coinbase Crypto Exchange at a rate of $1 equals 1 US dollar coin. Another kind of stablecoin is those backed by crypto assets. Like I have said countless times, they are very volatile, or can be volatile. Thanks to them being over-collateralized, value can be ensured. It works in a way that makes it kind of better than fiat-based stablecoins and also worse than them. If you have a crypto-backed stablecoin that is worth $5 and is tied to a crypto asset that is valued at $10, you automatically have $10. The good part is, if the crypto assets gain value by 50%, your $5 worth of coins are now worth $15 in fiat currency. Beautiful! Everyone wants that. But considering the volatility in the crypto market, the crypto assets might lose value to $2, turning your $5 worth of coins into $2 in fiat currency. Risky? Yes. That's the bad part about crypto-backed stablecoins. To avoid this, keep tabs on the crypto your coin is backed to. When the market becomes unfavorable for you, no rule says you can't leave. The next kind of stablecoins is those backed by precious metals like gold or silver, but mostly gold, because it has more value. These metals help the coins to maintain their value. Because these coins are centralized, investors see them as drawbacks, even if it helps to guard against volatility in the crypto industry. Gold, for a long time, has been a very good hedge to prevent inflation and volatility in the stock market. So it's not surprising it's important here. Stablecoins also make it easier for you to own precious metals without worrying about how to store or transport them. Algorithmic stablecoins are the next kind of coins, which is always pretty difficult for some people to understand. But let's break it down for you. You know how algorithms work? If you don't, it is similar to saying, if A is B, let C be D. But when A becomes C, let B be D. Simple, right? You bet! So these stablecoins are backed by a computer algorithm that helps to prevent the coins from fluctuating. If a stablecoin backed by an algorithm is pegged to $1, it will still be $1. If stablecoins gain value, the algorithm increases supply, which reduces the price of the coin. If the coin loses value, it cuts supply, which increases demand and also the value of the coin. Now, even though the number of coins you own might change, the value will always stay the same. So these are all the ways the different stablecoins backed by different assets work. They are marvels to behold, but the growing interest in stablecoins is because they offer a way to guard against the volatility of the stock market and the accessibility, storage, and mobility of assets. A very stable stablecoin will usher you into the world of DeFi to enjoy quick funds transfer, access to financial services without using applications, privacy, and very low transaction fees. These stablecoins might not be the crypto investment you are looking for if you plan to grow your finances, but it helps you cut down on potential risk while keeping the price of your initial investment stable. You can also use stablecoins for crypto staking, where you earn rewards for lending out your coins to help in the execution of transactions. But before you do that, do very thorough research, and crypto staking is as risky as crypto trading, although one is riskier. Yes, stablecoins are good, in fact, too good, but all that glitter is not gold, even if they are backed by gold. Some new tech for stablecoins might be very prone to cyber attack bugs or even total hijacking of your private keys, which can cost you all your investment. So remember to only use the money left after you set aside your savings and any other essential expenditures. Then you can buy stablecoins with those. To buy them, check if they're available in your location. Then go ahead and open an account in any crypto exchange, especially the ones that offer the type of stablecoins you want. If you like this video, don't hesitate to hit the thumbs up and subscribe icon to get more quality content like this. Till the next video, goodbye.